and welcome to Business Spotlight. I'm Bronwyn Seaborn. Well, the mining sector appears to be entering a new investment cycle, and it's shaping up to be a very different one to the last boom. Capital is tighter, investors are more selective, and projects are being judged not just on geology, but on discipline, execution and flexibility, especially as the energy transition reshapes demand for critical minerals. So to unpack how capital allocation in mining is changing and what separates projects that attract funding from those that don't, I'm joined by Tshepo Pitse, Principal for Mining and Critical Minerals at Nedbank CIB. Tshepo, thanks so much for your time today. So capital does appear to be becoming more selective across the mining industry. What is driving this shift? And further to that, how does that reshape the way projects are being financed right now?
No, thank you for that question. Limited access to capital is one of the major challenges that we find in the mining industry. With over $2 trillion of new mining investments required to meet the energy transition, funding flow has become tighter and investors have become more selective. And then with long development timelines, it means that early decisions on capital structure and sequencing has become more important. What we've seen is that companies that focus upfront on matching the risk to the right capital tend to find better success than companies that just treat capital raising as an administrative step.
Amidst all of this, we find alternative and blended financing really coming to the fore, and that begging the questions, where does this structure generally enhance project viability, and where does it start to kind of crowd out some of the long-term value? Because I guess if it's not carefully designed, while it may appear really helpful in the beginning, it could actually work against things in the end.
Yes, so alternative instruments play a critical role in terms of closing the funding gap for mining projects. And they do have advantages and disadvantages. And one of the advantages is that they're quick to execute, and then they're less dilutive than equity. And they've supported the mine development cycle over the years, even during tough mining conditions. However, they come with trade-offs. They typically, particularly for royalties and streams, when prices are high, they reduce upside. So that's one of the disadvantages. And then if they're locked in quite early, they could actually limit the refinancing options at a later stage in a mine's life. So this makes sequencing of the capital structure very important. Once the banks have anchored the senior debt in the structure, alternative instruments can be layered on at the right stage. And then that provides a lot of momentum for project funding and also provides flexibility in the finance plan at a later stage.
It does seem like investors then view all of this through very critical lenses to assess projects, to assess, how things are going to play out. But if we look beyond the resource itself then, because I know investors tend to focus a lot on that, what does separate the winners from the losers? I know you mentioned a couple of things in your first answer, but if you really unpack that from an investor's perspective, when they're looking at it very critically, what is separating those that come out on the other side and those that fall behind?
Yes, so investors tend to focus on 5 key areas. Firstly, it's technical maturity, where a project needs to show a clear pathway to bankability. And then secondly, you look at the permitting and the regulatory clarity. Unclarity and uncertainty during these factors leads to unnecessary and direct costs. And then thirdly, ESG considerations. These used to be just a narrative, but they're becoming a major risk factors for investors. And then fourthly, offtake certainty, particularly for critical minerals that do not have a deep market for sales. And then lastly, investors look at the management team's track record, which is very important. So together, all these factors can actually determine whether a project can attract capital and whether it can attract that capital at very competitive rates.
It really does sound like preparation and timing really are key in the whole process, and that makes me wonder, how does early collaboration with finances affect the outcomes? Because it would seem that the sooner you can get someone in to start helping you work through all these things, the more successful your outcome is going to be.
No, definitely. So early collaboration shapes the project before capital is raised and not after. So at Nedbank CIB, what we do is that we engage clients or work with clients during the scoping and feasibility stages in order to make sure that the technical due diligence, the contracting strategy, the capital planning of the project is aligned with what lenders and investors typically look out for.
Do you find that to be the trend, though? Are people really getting in on the ground stage, asking their financiers to step in? Or do you really feel that this is something that is still quite new out there, and so projects get quite advanced before financiers step in? What are we looking at when it comes to that?
Yes, so historically it's been a case where the capital planning is sort of an afterthought. But now recently with the tight market, we tend to work with clients at a much early stage in order to shape the outcome of the capital raise. And that's become very important for us as banks because we get to guide the process at an early stage instead of companies coming back to the banks and financiers at a later stage when the whole plan has been cooked, and then we have to unbundle and make sure that everything works for all the stakeholders.
So some positive developments in the right direction there at least. But given all of this, who stands out in this more disciplined environment? Because that's really what it feels like. It's, there's a lot of tick boxes that you have to do. It's not necessarily a bad thing. It's quite a good thing, I believe. But who stands out for you in this environment now? So
typically it's companies that engage the financiers up front, especially those with commodities that are not easily tradable. So the sooner you approach your financiers, whether it's banks or your streamers or off-takers, it typically helps because banks, those financiers are able to guide you in terms of what to look out for at a later stage when you need to raise the financing.
Right. Tshepo, thank you so much for your insights. We're unfortunately out of time for today, so let's leave it there. Tshepo Pitse is the Principal for Mining and Critical Minerals at Nedbank CIB. And that's where we leave things for now, but there's lots more to come on Business Day TV, so stay tuned.